And Dave Sussman back with you here at Valcor. Great to be with you here in, well, it's early autumn. Congratulations, everybody. We've made it to the third quarter. Delighted to have with us Jeff Gerstner, who is a principal at Superior Business Lending. And Superior Business Lending is a nationwide lending group. They work across all multiple different categories of lending and based out of the Chicago area. Jeff, right?
You got it. You got it. Absolutely, David.
Well, good to have you. And, you know, you and I have spoken over the years off and on about multiple different issues that are taking place. You know, I think I'm a few years older than you, but I haven't heard the word stagflation since I was in sixth grade, right? And
Exactly.
We're now starting to hear this this term stagflation, which is really a combination of slow economic growth or no economic growth with inflation rising and maybe even unemployment, which today, you know, the measures for unemployment are all across the board. We see people with you know, the participation index, I think it is, are the lowest it's been in quite a while. People just are choosing not to work. Give us your macro perspective of what you're seeing and what you're hearing from your clients.
You know, the stagflation, you know, the thing that to start it off quickly is where the Fed comes in and they're saying it's going to be transitory. It's proving not to be transitory in the businesses that we talk to. So you look at the small businesses, their question now is, how do I pass on a higher cost of labor? How do I pass on a higher cost of goods and services to their end customer? And a lot of them maybe don't have the pricing power that other, I would say, medium or higher middle market to, you know, the major companies where they, you know, they have the brand name. People will look quickly. They're concerned on losing business. So the concern for them is, if I start raising price up to keep my margins at a profitable level, they're concerned about losing business. So right now, with the Fed has always said it's transitory, it's going to move away. It's not appearing to be that way. You know, you struck on a very good point with just the unemployment piece. I mean, you drive down any street here in Chicago, in any street, I'm guessing anywhere in the country, and everyone has signs out, help wanted, especially in the service industry. It'll be very interesting to see how that gets passed on to customers as businesses have to pay more for labor. So we're seeing a lot of it. There's a big concern on it. It is, how can I pass this on to my customer and not lose said customer? So
yeah, we're seeing that with restaurants. We're seeing that with a whole different array of I mean, here's the problem. When the cost of supplies, and we've had a supply issue across the board now, supply chains are really suffering. There's a lot of stuff backed up all over the world. People are not getting the supplies in time, and when they are, they're being priced out of the market. If you don't price that into the cost, and that you don't, you know, price the cost into what you're selling, you're going to have to, excuse me, absorb that. And as a restaurant owner, I'm speaking to a lot of different restaurant owners. They're one of the hardest hit groups or subgroups from the coronavirus issue. Yeah, they're already at pretty slow, you know, really low margins, right? I mean, so how do they absorb an increasing cost without passing it on to the customer and losing market share?
Restaurant industry is always hard, always tight margins anyway. It's always about volume for them. You look at first they got hit with the shutdowns where, you know, say you have 10 tables and they need 8 or 7 filled consistently on a night to make it worthwhile to even be open, where they could be at half capacity. It wasn't even worth it for them to stay open. The thing that I've noticed really around here, especially in Chicago, where it's outside of the QSR, you know, franchise restaurant, quick service restaurant franchise model, outside of those, the restaurants you've seen, bars you've seen, even just a regular eatery that you see like for lunch, the ones that you can tell own the building, that have been around for years, that basically don't have rent, have been able to survive. It's been the ones where you can see where they didn't have maybe the rent flexibility and they haven't been able to afford the rent, especially when you're looking in the Lincoln Park, Lakeview area, you know, Bucktown, any of those places where rents are obviously higher, and obviously down in the Loop as well. But what you're seeing now, so they got hit with that. and now you're getting hit with a higher cost of labor. And, you know, we can decide if society as a whole is doing better with all the free money, but right now it's very hard for them. You can see subtle price increases, and we'll see. It's too hard to say. I think it's been too short of a time to say if it's really affected their business. But if we go out 3-6 months from now, I think you'll have a good idea. I think restaurants will be in a little bit more of a problem, assuming they can't continue to raise prices to keep up with the slim margins they have anyway. They have slim margins anyway. That's just the name of the game. And it needs to be a high turnover volume business on those tables. And they're just not able to do that right now. And it's just obviously at the cost. We'll see. So
when you're dealing with these low margin businesses, let's say they are renting, they don't own their own real estate. You guys provide a really wide array, a suite of services, if you will. What type of lending products would you suggest for them?
You know, for them, especially if they've been in business for, you know, the golden rule of obviously 2 years time in business is ideal. You know, we do help businesses shorter than that, you know, generally a revolving, you know, some type of line of credit, you know, either on the revolver or just a regular line of credit is probably their best bet. You know, you have higher interest rate options too, but that's just, you know, you like to stay away from those for the restaurants. You want to see the restaurants survive. You use the higher rates when you just have it. You need a bridge to get to that long term.
Yeah.
I would say revolving line of credit or just a true line of credit for a restaurant, because you're not going to really turn over the receipts as well to make it a true revolver.
Gotcha. You've been doing this for quite a while. I understand you were an options trader before that, or
yes,
an equity.
Sir. Yes, sir.
Yeah.
Yes,
so,
sir.
So
yeah, options and bonds. Yeah. So the
right.
last piece I was doing fixed income. So it's crazy how the curve really hasn't moved in, I don't know now, 12 years. It's crazy. Like the 10 years trade where it 1.3.
Yeah.
Which might be lower than when I left that, I guess about 6 years ago. It's crazy.
What do you say to an individual that's looking for lending, maybe for their business? One of the things that really concerns me is that we've been deluged with, let's call them loan brokers. Okay. There's been schools spitting out thousands of these people all across the country, saturating market areas. Do you find that there is a certain level of, let's use the word, quality that is required, people with experience, people with understanding and background to be able to navigate this economy that you're in right now?
It's yes, you need to have some type of experience in this. You can't run to the easiest, highest rate option and say that's the best thing. It just doesn't work. You know, we see a lot of deals, I would say daily, or even maybe more like weekly, where businesses are in debt they should not be in, and for whatever reason, either they're just over leveraged, or they're, you know, obviously in a higher rates than they should be, or just a product they shouldn't be in. And that's the thing I think that's hurting. Now that's also a combination of just kind of what's going on in the market, and I'm sure we'll get into that later. But you know, we get called a lot from, you know, we place debt, so you can call us kind of a broker too on some level. We help run a family office backed mezzanine fund here in the Chicagoland area. I think 5 to 10 or more or higher on a, you know, just need to not trip a covenant at a bank on an ABL.
And for our listeners, mezzanine is a secondary level loan that's stacked on top of the first primary loan.
Secondary level, absolutely. Sorry. Secondary level on top of, and it's unsecured in that there's an ABL generally at a bank, more in the manufacturing industrial, which we still do have, you know, a considerable amount around here in the Chicagoland area. And it's more just, hey, Jeff, you know, they have these covenants in their debt documents or loan documents, and they got to keep certain cash reserves, things like that. So that's where we'll come in and provide that filler, so they don't trip that covenant. Tripping the covenant being there, and you could say they're in a technical default. So that's what the tripping of a covenant it means. So when they do that, so that's when they call us up. Hey, Jeff, can we park 10 million here for 6 months? And we do that. It's unsecured, but there's a way. You know, you look at there's ways when you look at a deal like things like that, where with their existing loan they might have 85% against their AR when their general collection rate's 100% on that AR. There's obviously some room in there. Inventory at 50 or 70%. There's room in there, assuming it's the heavy type of inventory that can be resold. Same thing on equipment. So there's ways for us to work in there. So I guess the point being, we've seen every type of deal. We've worked with every type of situation. The thing that hurts that we hate to see right now is a lot of businesses are in debt they should not be in, or there's a better solution for them out there. And that's not good to see, I guess you would say.
We're in the business restructuring game. This is what Valcor does. We turn businesses around. We negotiate and restructure their debts. You do a certain level of that with their loans by refinancing their loans?
Mm-hmm. Yes. And we'll get involved sometimes on the restructuring type piece. We let people like you do that. You know that better than we do. I mean, that's life, right? I can't say, people say, well, what industry do you like to look at? We'll look at all of them as long as the debt makes sense, right? The debt just has to make sense. We've looked at every type of deal. The restructuring piece where you guys get involved, that's not our cup of tea. Do we negotiate with lenders? Sure, of course we do if we have to. Or if it's just something the borrower's like, hey, we got some room here, let's try to make it work. But, the guys like you, got groups like your group, send us a lot of deals just like, hey, help us get out. We're going to restructure this, but help us on this other piece. So we don't get a whole lot involved with that. But yeah, we're the guys that take it out, help to take out. It's a really interesting time in that too, where, borrowers right now think they don't need a restructure. It's a very interesting time where borrowers now think, when is the next, when's the next PPP? When's the next EIDL coming out? And it's a really,
I wanted
to
talk about that with you.
Yeah.
So it's a good segue, Jeff. We're now 18 months into this idea of free money, is the term you used. And every 4 to 6 months, there seems to have been another stimulus package passed. There's another package right now, which is really more or less an infrastructure budget that's trying to pass through Congress. Apparently, it's hitting some pretty big headwinds. It may not make it at this stage, but today is the 22nd of December, so who knows what it's going to be tomorrow. The fact is, though, is that I think you just pointed to something which is really concerning for a lot of us lay economists, if you will, you and I and other folks doing this, where we're seeing from a macro perspective companies across the country where we are almost conditioning business owners to the idea that there is going to be some other type of bailout. And I don't know how that continues. I don't know how, from a fiscally responsible standpoint, I guess that's a contradiction in terms in today's economy. But from a fiscally responsible perspective, you can't continue just running up, it's past $30 trillion in debt, $8 trillion on a national balance sheet for the Federal Reserve. It has to end at some point. What do you see? Do you think is there another round? If there isn't, how does that impact the economy?
They just upped the EIDL again. So what's going on since, you had, I'll give you kind of the quick and dirty. We obviously had PPP round one. I said all along on PPP round one, if you would just do some basic underwriting, the amount of fraud that got sent through the PPP round one, there was enough money in the round one to cover round 1, 2, and probably even round 3 of PPP, to be honest with you. But everybody was in this big rush where all you had to do was send in an application, be in business before February, 15th, 2020, and send a Form 940 in or just some payroll. That was it. It was just really, and just stuff was rubber stamped, just copious amounts of fraud. The amount of deals that we just, helped with, help find lenders that would actually work for, to get it done quickly. The amount of fraud we saw was an exorbitantly high number. I'd say probably 25 to 30%.
Wow.
And it was, you can only imagine, well, you see stuff's already coming out, and there's going to be more and more of that. And it'll be interesting to see. I don't know how you ever, I don't know how you ever make a reckoning for it or recover or show the true records, to be honest on it, because there's just going to be so much where it's just going to be, they're just not going to be able to contact said business owner, right? So it's going to get really, that's a whole different story. Now, then you had the EIDL, which they came out, which was, it is a loan. So the PPP, those are forgiven. It's basically free money, for lack of a better word, right?
Right.
So then you have the EIDL, which is a 30-year loan at 3 3/4%. Well, for some of these business owners, they're not borrowing anywhere near that rate right now. So this is like the best thing that could be possible for them. The problem you have, and the stuff that I've seen just a lot, even I would say in the last even month here for this on the EIDL, where I see groups that are not, are barely even credit worthy, that have over 150K of EIDL. And I don't know.
Explain EIDL for our audience.
That's that emergency disaster loan. That's
right. So that's a grant, right?
No, it's not a grant. It's a loan. You have to pay that back.
That is a loan. Okay, because I know
that is a loan. That is, yeah. The first like $1,000 they sent you was a grant, right? So when you got approved, you got like $1,000 or something, or maybe up to 10,000, I think, for the number of employees.
Okay.
But capped at 10. So that was considered a grant. It kind of got kind of pushed toward the PPP as well. But then it all got forgiven with the PPP, assuming you got your PPP forgiven. So that kind of did. So it's 30 years, 3 3/4, no interest payments for the first 2 years. So, I mean, the problem you have is that's great that the government's offering that. The thing that we're seeing a lot, even this, like I said, just really recently, where now you're getting the PPP burn off, you're starting to see a slower in the EIDL, where EIDL originally was 150, it went up to 500, and now they're talking 2 million. So I believe now people can be eligible, or businesses are eligible for 2 million. And it's just, they changed the requirements, they changed what you can use the money on, but it still stays the same, 30 years, 3 3/4. It is a great loan. I mean, if you look at it from that standpoint, it's just, I feel like it's become a lot of lender of last resort on a different level, where I think there's going to be a lot of issues with groups that do take them, that there might be defaults. And I'm talking sizable defaults, where, you know, you can kind of rubber stamp it based off of, you know, past tax returns and expenses and cost of goods sold. So to me, that's the scary part. Is
are they secured in any way, Jeff?
They'll throw a UCC lien, I believe, above 150.
Okay.
I believe above 150K. And that throws a whole nother can of worms in. Also, when you look at, if a business has an EIDL loan, or you know, has a sizable EIDL loan, or even just, you know, still has their PPP loan not forgiven, you have to get a subordination agreement with SBA to get out of their debt, right? Because SBA is leaning on everything. So that's that's another just, you know, headache to get more credit, I guess you would say, out in the marketplace. It just, everything's a slow process with SBA. They're so backed up with the amount of applications. I mean, we'll see. But what's been the result of that is every business owner thinks they're now eligible for more. They think if they have an issue at their bank, or where maybe they should be talking to your group right now, they're like, I'll wait. I'll wait and see what the next free money, or, you know, like I said, 30 years, 3 3/4, no payments for the first 2 years. I'll wait and see what the next piece is I get out of that. And then if that, maybe, hopefully that'll cover my shortfall. And that's, you know, kind of the way they look at it. And banks and lenders are kind of taking the same kind of attitude on it. It's really,
We've had this discussion with a few potential clients. I wouldn't say it's across the board for our clients. You know, listen, our clients are generally in a place where if they don't make a decision today, they're going to end up in litigation or bankruptcy tomorrow. So we're a little bit further down the pike with some of these guys, but I understand what you're saying, that there may be somebody that may be having some constraints, financial constraints right now. They would like to figure out how to nip and tuck, make things more comfortable. And let me just see what this administration or Congress is going to do in the next 3 to 6 months. I get that.
Let's put it this way. I'm guessing you're busy. You should be more busy than you are. And I think that's said across the industry. You look at, especially like in the turnaround industry right now, it's slow. And the reason it's slow is just, you know, everybody's just kind of, banks are not in a big rush to kick out a credit. Banks and businesses just kind of, it's almost like kind of a game of chicken where, well, something else might show up from the government. So let's just kind of wait and see.
I tell you what, we are busy. One of the things that we want to do is ensure and qualify our clients to make sure we can actually help them. We're not going to go through the gauntlet if we can't ultimately be successful. We're busy. We've been doing this for 30 years. You know, what we're seeing right now, in my mind, is unprecedented. But my biggest concern isn't the current environment we're in. My biggest concern is where we're going to be in 6 and 12 months down the road from now. I don't see this ending well. There are so many factors, whether it's geopolitical, whether it's macroeconomics in the United States, or it's economics across the world. It's not just the United States that's dealing with these contractions. We're seeing it everywhere. Listen, you flip the light switch off of the economy, global economy, you can't just turn it back on and expect the wheels to continue to hum right away. It's got to grind back up again. And there's going to be massive collateral damage. Well, where you've got major countries and cities across the United States and countries across the world that are still in some form of lockdown or restricting people, whether you have to show a vaccine or you have to wear a mask. A lot of people just don't want to go out. So it's definitely having an impact, and I don't think we're in Act 3 yet. Never mind, at the end of the story here where we're out of the woods. I think we're in there's storm clouds are on the horizon, and whether it's in commercial real estate, look what just happened in China, right? I mean, the crypto market took a dump this week. Mostly based upon what we saw with the commercial real estate property situation in China. A lot of people say that is going to be not contained to China, that's going to spread across the world. And I personally, and please disagree with me if you don't think this is true, I think the next major economic problem that takes place in the United States is going to be precipitated by just a huge loan default number through commercial real estate.
That's going to be a very interesting, part of the market to watch. Just globally, you look at everyone's come out and says it's no big deal with this Evergrande in China. It's no big deal. It's contained. These things have repercussions in just risk taking in general. So you look at if say it doesn't necessarily mean like they're going to collapse anything. It's just to do banks in general, where you look at it, where we start up with, the top of the top of the ladder with JP Morgan, Bank of America, Citi, Wells. Do they back off a little on a just a national, say just here in the United States? Do they back off just a little bit and say in the CRE market, or just anything, just in general? Hey, let's tighten up risk a little. That tightens credit, right? So in general, that tightens credit, where then other people where businesses maybe could have talked to a JP Morgan, they just got to start moving down, and cost of capital then goes up slightly for some of these businesses. So I can't CRE. You look at here in Chicago, there's very few people down in the Loop still, and you look at I would say there's 30% foot traffic of what there normally is.
And Loop is your downtown area, Michigan, Rush.
Loop financial district, absolutely.
Yep.
And you look at down there, it's just not a lot of activity. People, do they want to make the hour commute from a suburb to come downtown, when right now I can be just as productive, and there's not a lot of people to meet with downtown. So that's the whole thing, where it becomes, I'll go downtown maybe once a week and into the true downtown Loop area, just because there's not as many people down there. There's not as many people to meet with, right? And then you have some businesses, the owners aren't there. Hey, we'll just meet up in Lincoln Park. We'll meet in the suburbs, wherever. So it's been, and that we had an enormous amount of building in the CRE market in downtown Chicago. Well, it'll be interesting to see how the office area downtown holds up through all of this. I know a lot, 9 out of 10 businesses, maybe more, are downsizing, right? In terms of taking
9 out of 10,
lower amount of, it's insane. Wow. Who's really taking on more space downtown right now? So,
so what happens to the investors? What happens to the guys that risk everything, invested in a strip mall or an office park or office building or, whatever it may be? And they've still got there's no moratorium on their loans, but they don't have the tenants anymore. What happens to those loans?
I guess I would say your guess is as good as mine. It becomes a thing of, do we work them out from a banking standpoint? And the bank's got to decide that, where, do they want to take back to, a restructuring piece? Do they want to take a haircut, they being the lender? Or can they just hold on, and maybe there's some next, back to what we said, is there another I don't know, some type of package coming from the federal government to help us. That's it. Hey, yeah, maybe there's something that'll come out that, he can run it through his property management company and he'll get another, whatever the number is. And he can use that for his rent payments or his, I beg your pardon, his mortgage payments. So it's just a fascinating dynamic right now. I met with someone at the JW Marriott a couple times in the last couple of weeks, and that, downtown on Adams Street, fabulous hotel, fabulous lobby. There's just nobody there. And it's just dead compared to the way it was, 20 months ago, where it's just the place was hopping all the time.
And you're not seeing a level of lockdown that you see in other major cities in the United States. You don't have that in Chicago, do you?
Not anymore. No,
right.
It's pretty open. The people, they want you to wear the mask indoors.
So
when you're
it's
walking
fairly
through
opened
office,
up. You're not required.
Fairly open. Absolutely.
You're not required to show vaccines to get into restaurants.
No, not yet. And it's going to come down to how do you enforce that too, right? You look at a little restaurant.
They're enforcing it in New York. They're enforcing it.
They're enforcing in New York, but how are you going to get? So I go back to how are you going to get a smaller restaurant, not even in the downtown, that's going to really want to get into that argument right now. They need the customers. They're trying to keep their business open, especially a family run, family owned business. I mean, I don't think there's the political fight right now to say put a mask on. I haven't seen anybody when I've gone into a store or a restaurant where somebody doesn't have a mask. No one's gone up to them and said put a mask on. So I haven't. So
in a relatively more open environment, Chicagoland, Greater Chicago, you're still seeing that the numbers of people that are going out, that are venturing out and going to hotels and restaurants and such is still very, very low.
Still low.
Okay.
Mm-hmm.
So that's concerning. That's really concerning.
But that's the thing. That's the concern for the downtown office space. You look at, to me, that's a big thing. And I just don't, it comes down to, when do the banks feel that they need to kick that troubled debt out? Do they hold on and hope that there's some type of relief package that comes through Congress again? It's such a weird, interesting dynamic all at the same time, where you have these business owners or building owners, however you want to look at it, that have a troubled credit, that feel like they have the ball in their court and like they hold all the cards, and the lender thinks they own all the cards. And it's just the weirdest kind of, like, the bank doesn't really want to kick them out. They don't want to take the haircut. And you have a business owner that thinks, well, what's the bank going to do to me? Or I have more federal money is going to be coming my way. I mean, it's hard to argue. It's hard to argue with said business owner that there might not be more federal money coming.
Yeah, well, free money is free money, right? Or
who's going to say it's not? Who's going to say it's not coming? Yeah, I mean, how could you as a lender say, well, you're right, maybe we should just wait 3 months?
Yeah, I mean, it's really, from a political standpoint, and we don't venture into, one side or another on the political aisle here. We just take a look at the policy that's being enacted. A lot of people raise policy as a political issue, but no, it's an economic issue that's impacting all small businesses, your clients, our clients, and the macroeconomy at large. What we're seeing right now with the massive infrastructure, people are saying that they're trying to pass 5 trillion, not 3 trillion, and 90% of that isn't for infrastructure. I don't want to get into the political side of it. It may not pass. It doesn't look like it's going to pass right now. But do you think there is an appetite in the next 3, 6, 12 months to pass more stimulus packages, to pass more cheap loans or free money and grants and such? And if that doesn't go through, how does that impact the economy?
I think it's the hardest thing to guess right now is what they might pass again, in terms of whether it's 1 trillion or, I mean, the numbers are just staggering anyway. When you I look at it from the standpoint of, forget, like you said, it doesn't matter which side. I look at it from why don't we save some bullets for when we have the next downturn? Now, that would be me. But, when you look at stocks at all-time highs, you can make the argument a lot of large businesses are doing well. The small to lower middle market are struggling still.
Yeah.
So are you going to be able to pass something for them? I don't know. Like I said, it's the biggest game of chicken right now between, like I said, you have these business owners that think it's coming, and the bank thinks, hey, maybe it is. And everybody thinks they hold all the cards, especially on the troubled credit. Every day that goes past on the troubled credits that you don't, say, find a better solution, and your business doesn't get better and they don't pass new stimulus for you, it's going to be harder and or more expensive for you to get out the other way. So that's the thing that, that's the thing that banks and I think private lenders and businesses all have to realize is every day you wait and things don't get better or that stimulus does not come, then it's going to be that much more expensive and that harder to get out. And maybe a bigger haircut for the bank to take to move them out. And that's the thing. I think that's what I think the ramification is if more stimulus isn't passed and banks don't get aggressive, private lenders don't get aggressive on starting to move some of the troubled credits out, because they are out there. We just see them. It's just, we know they're out there, but they're not like there's not this rush to move them out. So we'll see. It's really interesting. Back to your point on, and I don't know. It's crazy the amount of coal deals we've seen recently, which is, what is coal used for? It's, used for power, and it's also used for steel, right? So infrastructure. Right. So, we'll see. If it comes in, and like you said, if it's a big infrastructure piece and not just other things that are passed, like we said, it's not, if it's 90% something else and only 10% infrastructure, but if it's truly more on the infrastructure side, and they truly do need the steel and things like that, you're going to see these industries like coal again that start doing well. You look at coal prices have gone up, and I don't know if that's an anticipation or that's just inflation. I don't know. But there's not a lot of coal
prices
around.
Across the board.
They're just gone up, right?
Everything.
So, it is what it is.
Let me ask you another, you may be hearing from clients on this as well. They're talking about tax increases and massive tax increases. And, it's going with the idea that, the rich need to pay their fair share, and we can argue that. That's fine. But when you actually start taking a look at the real numbers that are being presented, it's going to impact everybody. It's going to impact lower class, middle class, because even if you're not personally taxed, you're going to have to pay higher prices because those taxes are going to be passed down to you. What do you, the issue that I'm hearing, and you deal with a lot of small, medium-sized business owners as well, SMBs. The issue that I don't hear anybody talking about in the mainstream media, in the financial pages, is this. And I'd love your input on this. They talk about $400,000 a year being the trigger, right? So anybody earning under $400,000 a year, which is a lot of money, won't have a tax increase. Okay. But if you break that down, well, first of all, that could be a joint tax return. So you have two people working, possibly, or it could be a sole proprietorship. There are millions of businesses, small 1, 2, 3-man operations in this country that run as sole proprietorships and file their tax returns together with their individual tax returns. And a small business making $400,000 a year is not a lot of money. And you're talking about a massive tax increase. Are you hearing about this? Are you hearing any concern?
The concern I'm hearing more from on that, I don't hear it as much on just the tax. I'm seeing more on let me sell this business quicker. So that's what I'm seeing more of, where it's,
let me sell?
I would say some of these, let me sell my business quicker.
So they want out.
Especially people that are, So that 1 to 3-man shop, say it's an HVAC or whatever it is.
Right.
They're looking to get out and hopefully avoid any tax increase on, especially, capital gains or anything else. That's what I'm hearing more of. There's always, like you said, and you make the good point that's not brought up a lot about it. A business that is tax tired will charge more. So the pass on to the customer is an effect. And in theory, that's a tax on everybody then, right? So back to your point, it does trickle down from that. And the trickle down will be if said business owner, you're seeing more people that are close to retirement, I'm going to try to sell now. So you're getting this deluge of people trying to get out before year end. What you're seeing, but who knows if they come with something retroactive, right? Isn't that part of the bill where they might go retroactive on this piece, where it's the capital gains?
Yeah, they want to. They want to push it back to 1978.
There you go. But you know what I'm saying. So that's the concern. Is like, well, what's the point if it's retroactive? Since at the beginning of this year or 1978. That's that's the bigger concern, I think, right now is just that. But like you said, that's the point that, and when we talk to the business owner, they're like, I got to figure out how to pass that on then, Jeff, because I got to still, because then I'm just running, especially on, like I said, you get these tighter margin business, whatever they might be. We said restaurants, but there's other tighter margin business that have a lot of competition that are, the 1, 2, 3, 4, whatever person shop, family run. And they're breaking even as is, right on the bottom line. They make a little, we'll say. And I'm talking 50, 100K maybe on the bottom line. It's a nice business, though. They pay themselves a salary, but the profit there's not an enormous amount of, like you could say, a dividend to them at the end of the year. Their concern is, how do I pass that on to the customer, which then affects everyone, right? So that's a tax on, it's not a tax, but it is a tax in theory, because they're going to pass it on to upper, middle, lower, every person that they service, right? It's just, that's how it gets passed on. And I think for those that don't sell, or, they're always looking, how can I keep my margin no matter what the business environment is? Because they can't do a lot about it if they do pass the tax increase, other than I'm going to try to pass that tax increase on to my customer in a price increase. And those that can do it will do it. And that's you could call that a tax on everybody then. Absolutely.
Yeah.
So.
We're coming to the end here, Jeff, but what they say is inflation is a tax on everybody, right? And that's the greatest tax of all, because nobody voted for it. But Jeff, let everybody know about Superior Business Lending and where they can find you, and more information about how you guys can help them.
Yep. The website's www.superiorbusinesslending.com. The name's Jeff Gerstner. I'm on LinkedIn too. You can just look us up. All the contacts are there. Give us a call on anything. We always will jump on a call, as you know, David, and talk a deal. We're pretty easy to work with, I think. We got people and analysts that can go through your deal. So just let us know. We work on deals. I would say pre-COVID, we were 2 to 7 million was probably our sweet spot where we saw most of our deals. Now it's usually 10 million and up, just because of the PPP and EIDL eating everything up. But we work on deals even a lot smaller than that, especially on people, get referred to us all the time. We help this person out with a $30,000 line of credit. I mean, so it's, it's how you build relationships and try to start to scale, if you will. And that's just how the name of the game works. We'd love to work with anybody.
Well, there's a few folks I really enjoy my conversations with over the years, and Jeff, you're definitely one of them. It's always insightful. You got your finger on the pulse of what's definitely happening out there, not just in Chicago, but across the country. So greatly appreciate your time, my friend. Thank you so much.
Thank you, David. Thank you. Always great to catch up, David.
Likewise,
thanks a lot.
Jeff.
Thanks for the invite. Let's talk soon, man. Thanks,
Absolutely.
David. Thanks.
Take care. Thanks, Jeff. And everybody should check out Superior Business Lending. And if you have any questions for us, don't hesitate to give us a phone call at 877-2-VALCOR, or you can find us at valcorworldwide.com. If your business needs some help, we're here to help you. If you're looking to provide our services locally, let us know, and we can check to see whether or not your region is available. And you could be providing business restructuring, turnaround, and capital acquisition services, working with good folks like Jeff Gerstner over at Superior Business Lending. And until next time, folks, thanks for joining us here at Valcor. I'm David Sussman, and we'll talk soon.